Hi, folks, and welcome to another edition of Money in Politics. This is March the 5th, and we're coming to you tonight without a bag over my head. And for once, I can hold my head high this week. Actually, back on Monday was a pretty good day. And on that, I'm going to talk to you tonight briefly. I'm not going to do a half-hour version as I've done the last couple of nights. But let me just remind you really quickly. Let's talk a little bit about volatility. Then we're all kind of learning these lessons, and I'm going to drive them home based upon what we know that happened. When we look at the graphic that I put together, and we see this was about the split. So a week ago yesterday, we closed at 85 cents, which was 10,000 shares were worth $8,500. And we were talking about the split, and Monday was March the 1st. At that point, we had 2,500 shares, and the price of Humble on Monday closed at $5.98. Today, the price of Humble closed at $3.50. And this is the one-day chart for the action of today. So we certainly have seen our share of volatility this last week. And for those of you who are getting used to trying to hold on to your nerve, this is the kind of trading activity that can really drive you crazy. So the 85 cents that we had on last Thursday, if you divide today's 350 by 4, our price today would be 87 cents. And when you look at this chart that I have on the screen, remember that we went up 42% a week ago today to close at, I believe it was like $6, and I don't have that off the top of my head right now, but we went up 42%, and on Monday, March the 1st, we went up 23%. So a 42% and a 23%, and that meant that our investment went from $8,500 in 2 days, 2 trading days, to $14,950. When you pick up virtually $7,000 in 2 trading days, that's a time where you could trim some money. And we've talked about that. These are some basic ideas. I wanted to, let me bring up one of the great investors of all time, and I mentioned him the other night, was Peter Lynch. Peter Lynch, who ran the Magellan Fund. And for something like 13 years in a row, I'm going from memory here, so don't criticize me if I'm off a little bit. But for something like 13 years in a row, the Magellan Fund had a return of 20% or better. Even if I'm off on the details, the point is Peter Lynch knew what he was doing. And I want to play this as a clip of Peter Lynch talking about volatility at the National Press Club in Washington, D.C. This was from around 1994. And what he has to say is important, so take a listen.
What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly, but we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen.
So that's it. No one knows better than Peter Lynch. And as he says, the markets go up and down, and you just have to know that. And we're going to have, on average, these corrections, and we can look back in history. So while a lot of you, and again, money in politics is designed for you, the new investors, because I want you to get in the game. I don't want you to get out of the game. I don't want you to get scared out of the game. Now, I am not a big investor of penny stocks. Since I bought Humble, I've actually bought a couple just to play with it. But I've rarely, in the last 40 years, ever bought a penny stock. I don't look at Humble, as I've said before, as a penny stock. Technically, it was certainly just a month ago or so. Apologize, I got something in my eye. I remember back in January, it was at 20 cents. So, but with the management team it has and all that we've gone through with the services they have, as I said before, they're not selling lemonade on the street corner. I mean, this is a real viable company that is, I think, poised for real growth. And why do I always talk about Humble? One, because I know so many of my followers are buyers of Humble. And two, we're using that many times, as in tonight, to make some lessons. And so we're talking about volatility. And now over the last week, we can see the lesson in the volatility. And when we take a look real quick, here we go. Well, let's see, I wanted a 5. Let me do this again. Let's try a 5-day chart. There you go. Yeah, it's gut-wrenching when you go down like every day being beaten down. And at least today, we went down to a low of, I think it was $2.86, $2.84 there. But we closed up. We closed up on the day, and who knows where it's going to go tomorrow. This is why I wanted to bring you about Peter Lynch and others and say, folks, volatility is just part of the game. As I mentioned to you last night, you want volatility. Volatility means that you can go back and buy these things cheaper. When we had the growth on Friday, when we had the growth on Monday, when it went up to $6 and what was it, 38 cents, I think is a high on Monday, you were able to go back and buy it today if you were so inclined. You were able to go back and buy the stock at $2.80 something cents. And if you divide by 4, let me just quickly do that. You got $2 and let's say 86 cents divided by 4. The equivalent price was 71 cents. I didn't think we'd ever see that again. So I tell you, when I'm talking here, every minute seems to go by in about 20 seconds. So that's pretty much it. I mentioned DIG yesterday. I'm just going to bring that up because you want to have some diversity. Here's DIG today, up 10%. I should mention forwardly, which I don't have a graph right now to bring up for you, but forwardly is closed at 63.5 cents, up almost 20%, 19.8%. But sometimes people say, well, when I talk about stocks that aren't penny stocks, I say, they go, well, I want to buy penny stocks because I can buy something cheap. And what I would say is, cheap isn't necessarily that great. You want to be able to buy a stock that goes up in value. I don't know if I can, let's see, click on this. Yeah, well, here we go. Even if you had bought back in November, as I said, or back here, this is October. This was a stock, $49. We didn't have the vaccine then, but we did have it in November, which is why I started to buy this. Once we had the vaccine, then we knew we were going to be opening up the economy. So folks, think about what you know, what is in the news. And then you can act accordingly. Some of the investments we hold, like DIG, is a short-term play for me. Now, I told you I had a friend who has enough money to buy, she bought 600 shares back in November. I talked to her today, and we agreed to start to sell some of that. Because remember, as I told you yesterday, pick a couple of apples off the tree now and then. And by that, I mean take some cash out. When you got in, or when she got in, if you get into something and it doubles in less than a year, goes up 100%, don't just sit there. Take some money out. Look at what we had with, and I'll blame myself that I didn't say you guys to do that. But, when we went up as much as we did, and let's see if we can go up. I don't know if I can bring that up. Let's see. If we can do 1 month chart, well, again, I don't like this chart, but anyway. It doesn't show the highs as much as I would have liked to, but here, this was a pretty good period of time. Anyway, the bottom line is, folks, I'm trying not to go too long. When you go up as much as you did, and maybe let me just bring that DIG chart back. And back in November, as I said, we bought it at about 63, and now it is $137, up another 7.5% today. I told you the other day I liked it, and it was at about 120. Now it's up 17 points. Where could it go? Back in 2018, it was $400. Do I expect it to go to $400? No, I don't. Could it? It could. Could it double from here? It could. That would be 270, let's say, to make math simple. And in January of 2020, it was $260. So if it went up $100 from here, it would be $237. With that in mind, I think DIG still has a long way to go. And with that in mind, don't be afraid to buy 1 share, 2 shares, 5 shares, maybe 10 shares. Something I'm not going to go in tonight because it's Friday night, and I hope you're maybe going to be watching this on Saturday, because on Friday you were out, perhaps at a bar, perhaps with friends. But even if you buy 10 shares, folks, here's the thing. You want your money to grow, and listen to me on this. You want your money to grow on a percentage basis. Don't just be so enamored with owning 5,000 or 10,000 or 20,000 shares. The great thing about owning a bunch of shares, if you had 10,000 shares and it goes up $1, your net worth goes up $10,000. So that's a good thing. But don't be passing up the chance to sometimes double your money on things just because the price is not a penny stock. So I'm going to wrap up. Let's go out and have something fun to do on a Friday night. I would just remind you what Peter Lynch said, what you experienced this last week. If you remember this week, don't remember it just as the pain. Remember that it went up and it went down, and on Friday here it went back up, and you felt a lot better. And maybe you're still licking your wounds, but let this week be an object lesson on volatility. You have to be able to manage your emotions when you have stocks going up and down. And if you want safety, and this is what so much of the financial industry wants to sell you. They don't want to sell you growth of your money. They often want to be selling you safety. You don't want to do this on your own, Bob. You don't want to do this on your own, Sally. You'll be losing money. You don't know what you're doing. You need a professional to manage your money, right? That's what they're going to be selling you. They're selling you safety. And what I'm telling is, if you can just manage your emotions and ride the roller coaster ride of stocks, and if you're in a company that is decent, or if you're in an ETF, DIG is an ETF. You're diversified already. then you can make money, and you can make a lot more money than the pros, okay? Peter Lynch was famous
What you learn from history is the market goes down.
saying that the small guy can beat the big guys on Wall Street. He was right then, and I'm right now telling you the same story. You can grow your wealth. Just don't expect to become a millionaire in a week or a month or even a year, although that could possibly happen. But do think in terms of 5 years and 10 years, and think in terms of learning your lessons. All right? I've already gone long enough. Have a great weekend, and we will see you Monday, and hopefully it'll be a prosperous week. Spring is coming just around the corner, so we will be enjoying it together, and we'll start looking at some other stocks in addition to Humble. Oh, one last thing, and I meant to say, give us a thumbs up. Tell us if you know some great dividend stocks. Give me that in the message as well. I probably should have said that a lot earlier. Take care, folks.